Hi, welcome to the East Asia Econ YouTube channel. I'm Paul Cavey. I'm the founder of East Asia Econ. Today I'm going to talk about China's economy, and the argument, I've argued in a previous video, that deflation should be bottoming out in China. I'm going to build on that today and try to say what's the argument for China becoming more positive during the course of 2026, particularly in terms of markets. And the kind of the catchphrase for that is sort of domestic so-so, external go-go. So the idea is that domestic side is still pretty weak, which is what a lot of people focus on. But things externally, particularly in terms of capital flows, are starting to change. And that could really make a difference to the way that China's economy looks during the course of 2026. That's what I'm going to get into. First of all, I have three requests. The first is, if you're watching this video and you find it interesting, then please do subscribe. And also recommend to your friends, or frankly anybody else you might know, that this is a good video to be watching, a good site to be engaged with. That would really help me a lot. The second thing is, check out our website. We have a daily service that's really designed for retail investors who want to know about what's happening in the region in terms of macro markets. On the website, you'll find some examples of that. There's also a bunch of interactive charts where you can get updated data on what's happening, and also some different visualizations. For example, if we're tracking at what's happening with China's exports around the world in terms of auto sector, for example, which has been one of the big growth areas of recent months. So please check out the website, eastasiaecon.com. The third thing is, if you're a professional investor, then please think about subscribing to eastasiaecon.com's professional service. So we produce things every day, tracking all of the data across the region, looking in terms of what that means for cycles, central banks and interest rates and so on, and also doing a lot of structural work, thinking about some of the thematics across the region and what might drive markets, not just in the specific economies, but trying to think about some of the regional trends as well. If you're interested in that, then please get in touch with me directly, paul@eastasiaecon.com. And then with that, on with the show. So again, what I wanted to talk about today was what's happening in China. And China, I think there's a very clear distinction between what's happening domestically and what's happening externally. So I'm going to start off talking about the domestic side, which still looks predominantly quite weak, then talk about the external side, and then thinking about what the market implications of all that might be. So the domestic side. I've been arguing, for the course of the few months, I've been thinking that the domestic side was showing signs of bottoming out. And there was maybe three or four things pointing in that direction. First was that property starts and property construction looked like it was beginning to stabilize. Property starts down from 80% from the peak. That was probably big enough fall, and therefore there were signs that on a month-on-month basis, property starts were no longer falling. Related to that, I've been looking, one of the indicators I like the most is the percentage of demand deposits that households have compared with their time deposits. It's an indication, I think, of where households are willing to put their money. And so that also, a lot like property starts, looked like it was starting to bottom out during the course of 2025. And there are a couple of things to add. So import demand looked like it was starting to pick up. I mean, not a lot, but at least no longer falling. And finally, there were signs that inflation was beginning to get a bit better, that deflation risks were beginning to recede. Now that's, I think, the picture going to the fourth quarter of last year. Since then, it still looks very so-so. So in the sense that the property market, property started to fall again in the fourth quarter of last year. Now again, they're down by 80% from the peak. It's very unlikely that property starts are going to fall a huge amount more from here. And most of the damage from the decline in the property sector is probably now done. But nonetheless, it still looks very weak. And related to that, again, when we look at demand deposits versus time deposits, or M1 versus M2, which is maybe an easier proxy for that, as this chart shows, again, it's not dropping a lot, but it still doesn't look like there's a very firm floor to this. And so some of the domestic stuff that I've been looking at, it still doesn't look great. The two areas where there still are some signs of improvement, even if it is quite modest, is first of all the import side, where into the end of last year, import demand does look like it's continuing to pick up. And sort of interestingly, that's now being seen in capital goods imports, which isn't really what you would expect given the big falls off in FAI numbers that we've seen in China, and also the fact that there's so much import substitution in the capital goods sector. So again, I think that's something that gives a bit of optimism about where the economy might be going. Perhaps the main thing that's changed is inflation. And over the course of the last 3 to 4 months or so, the GDP deflator has now started to improve. So it was dropping like month on month for a few quarters, but since the third quarter of last year, it started to improve. And the data that was released, with the GDP numbers for the fourth quarter of last year showed a further improvement. So I think that is significant. Like, it does show that deflation is no longer getting worse. That's partly because of what's been happening with food prices, and that is not really related to the real economy, but does help the headline numbers in China. But it's also what's happening with PPI inflation, so producer price inflation, upstream prices. And what you've seen, as this chart shows, I think, is that basically prices fell for a long time. But since June, PPI has stopped falling. So it's basically been flat in level terms for the course of the last 6 months, which is a significant change. It's not increasing, but it's no longer declining. And so in that sense, deflation has basically ended in China for the time being. Now, that's what I want to say about the domestic side. So as I say, it's so-so, right? Like, there's some things which look a little bit better, some things which still look very weak. So I don't think if we were just looking at the domestic economy that we could be arguing that China is getting much better in the course of 2026. So the other thing, though, is to think about the external side. And I think it's the external side that really explains a lot of what's happening with PPI and actually helps to explain why there might be a better outlook for China in the course of 2026. So what's happening with PPI, when we look at the breakdown of it, it is true that building materials prices, a bit like property starts, are no longer getting much worse. Again, a bit like property starts, prices of cement and so on are down by 60, 70, 80% from the peak. So there's been a huge implosion of the property market. It doesn't look like it's getting much worse. But the big driver was what's happening in PPI is the same sort of stuff that we're seeing in the rest of the world, which is the copper price, for example, is very strong. And as you will see, if you're an investor and you watch what's happening with markets, what's happened over the course of the last 6 months is quite a big pickup in base metals prices across the world and metals prices generally. And that then is something that's feeding into China. And as this chart shows, historically, when we've seen metals prices in the rest of the world rising, we've tended to see PPI in China also starting to rise. Now, the backdrop to this global phenomenon, like, you can talk about sort of individual things like the energy transition that's playing a role and specific demand in terms of, what's happening with AI and so on. But the general picture for this is that the US dollar has been weakening. In level terms, it's not particularly weak, but at least in terms of the rate of change, there has been a shift over the course of the last 12 months. And usually when the US dollar is weakening, we tend to see global commodity prices rising, and that also gets reflected in the PPI in China. So there is an external factor going on here, which helps to explain why PPI inflation in China is no longer getting worse. The other thing that tends to happen when the US dollar is weakening is that the CNY tends to appreciate, and that's shown by this chart. And that shouldn't be a surprise given the way that the PBC manages the currency. But again, it is important because it is something which then, when the currency starts to appreciate in China, it's something that tends to attract money in from the rest of the world. And actually, that's also another external change that then we're beginning to see. And so over the course of the last 6 months or so, whereas China previously was seeming to suffer from capital outflows, it's difficult to track these data in China. PBC, the standard way of doing it, looking at foreign exchange reserves of the central bank, that doesn't seem to adequately capture all of the foreign exchange reserves that the central bank actually has in China. So it's become a bit more difficult to measure. But one thing that is clear is this number, which is the FX settlement number, which does look like a fairly clean measure of how net of the momentum of outflows or inflows of money into the economy. At the end of last year, there was a big increase in net inflows into China. Now that then is important. So what we're seeing is that the US dollar is weakening. That's putting pressure on the CNY to appreciate. As there's pressure for the CNY to appreciate, then it becomes more meaningful for people to start to hold CNY assets. So money starts to come back in. That then gets reflected in these capital inflows. And that, I think, again, is the second thing that's playing out and why it's important for domestic markets in China. You've got metals prices improving, some weakness of the US dollar, and both of those things getting reflected in a stabilisation of domestic interest rates in China, allowing the CNY to be stronger and capital inflows start to come back in. And that basically is the picture that we're seeing playing out in China over the course of the last 3 to 4 months or so. Now, again, China still has deflation, right? Like it still is a weak economy. The GDP data is still negative. So I think it's very unlikely at this point in time that the central bank has an incentive to allow the CNY to appreciate a lot. But these capital inflows are still important and are still positive for China. And it's not, I don't think the government is particularly worried in terms of the export sector losing competitiveness, that it needs the currency to be weak. But I think it would be worried about the impact on inflation. Because as this chart shows, this relationship between import prices and the PPI, you would expect that if the currency appreciates, import price inflation will come down. And that's been one of the few things that's been driving inflation up. So there is an incentive, I think, to keep the currency, to prevent the currency from appreciating too much. But that can still be positive for China's economy, because essentially what would drive domestic money supply flow and therefore help domestic reflation is that money comes in from the rest of the world that isn't sterilized by the central bank. So it increases the domestic money supply and therefore helps prices start to rise. And I think that basically is the process to be looking for in China during the course of 2026, that these different things that are happening externally, the stabilization of producer prices, the weakening of the US dollar, it's basically the same sort of reflationary process that's helping the rest of the EM. That also that starts to help China and helps China with a domestic reflation process. And that, I think, is the positive argument for China this year. Ultimately, that should help to boost domestic demand and help with the signs of the stabilization of the property market that I was hoping to see more of during the course of 2025. But still, it's something which I think can expect to be play out a little bit more during the course of 2026. So what would this mean? What would be the market implications of this? So I think one thing is that, if inflation is stabilizing and starting to rise because of these pressures that are coming from the rest of the world, it does mean that there's less pressure on the central bank in China to cut interest rates. And one of the arguments I've made in a previous video is that actually the pressure for China to cut interest rates has already been receding. And I think that remains the case. So we're probably not entirely through the loosening process in China, but I think it's much less likely that interest rates fall very much from here. And that's something that helps to reinforce the pressure on the currency. I don't think we actually will see the currency appreciate too much because of these concerns about deflation that the authorities still have. But I think that is what the way that the capital inflows will be managed is through a process of unsterilized intervention, which allows the domestic money supply to increase. And then that's something that feeds into equity prices in particular starting to do better. So I think it is a story where for the currency, it's not so positive, or the currency and the interest rate markets are lagging. And where the pressure for the appreciation of the currency starts to flow through in terms of domestic markets is really through the equity market. And that's, again, that's been the thing that's been increasing in the course of the last 6 months, and I think can remain in this kind of narrative, can continue to remain the course in the course of the next 6 months. So that's the kind of the part on the domestic story in China. There's 3 other things I think are worth bearing in mind about the implications of these pressures playing out in China and how that might play out. So the first is what the US response to this is. So essentially, I'm arguing that there's going to be pressure for the currency to appreciate, but the central bank in China is going to stand against that and allow domestic reflation rather than appreciation of the currency. Now, in the past, the US would have complained about this, and that to some extent would have mattered to China. I think in the current global environment, it's probably not going to matter at all. I mean, apart from the fact that the central bank in China seems to have a lot of ways to obscure the monetary policy management that it's doing. Apart from that, clearly, given global geopolitics, it doesn't look like China has much need really to pay attention to US criticism at all. So I think kind of the pressure coming from the US, it's really not going to amount to very much. The second thing for Asian currencies more generally, like this change, as much as I don't think the CNY is going to appreciate very much, like it still is a change, right? Like for the course of the last, since 2021, the very clear narrative in China has been interest rates going lower and the currency getting weaker. Now, there's obviously another big fish in thinking about like what determines regional currencies, which is the weakness of the yen. So the CNY isn't the only thing, the only big currency which is weak. But nonetheless, China is the biggest economy in the region. Where the CNY goes, therefore, does matter for regional currencies. So I think there is potential that this change in direction for the CNY which looks like it should have momentum at least for the course of the next 6 months or so, it can have an impact on the rest of the region, where not just the yen, but the Korean won and the Taiwan dollar are also very weak. So the second thing to be thinking about, US objections is one. The second thing to be thinking about is whether this can start to lead to pressure for currency appreciation across the region more generally. The third thing is, and again, this isn't something that's particularly going to concern the Chinese authorities, but is maybe worth highlighting, that actually, like what I'm saying is the story is very much dependent on external pressures. This isn't a story about domestic policy in China becoming effective and that allows the economy to start to recover. The mechanism for a recovery in China's economy based on this kind of narrative, it all is dependent on what's happening in the rest of the world, and in particular the direction of the US dollar and what's happening with global prices. Now, neither of those things is in control of the Chinese authorities. So in terms of watching where we go, those two factors then become very important for thinking about China's domestic cycle, and it also means that China itself can't really do very much to influence those things. So it is an externally driven picture, but nonetheless, given we've been in a situation where for the last 3 to 4 years nothing really seems to turn China's economy around, that there is now at least a mechanism for that to start to take place, I think is still something that's worth being aware of. As I said, I'm Paul Cavey, the founder of East Asia Econ. These are some of the sort of cyclical things we're looking at China at the moment. We also look at all of the other economies around the world or around the region. You can check out all of that on the website, eastasiaecon.com. Please get in touch if you're interested to know more. Thanks very much.